Today we're going to be looking at something a bit different. We're going to be looking at crypto options. Now, crypto options is something which is not often talked about in the cryptocurrency algorithmic trading space, but it is a very powerful way to make money if you know what you're doing. It does come with some complexity and some domain knowledge which needs to be mastered, but with the right tools, you can make profitable returns and manage risks properly. So today we're going to be looking at a Python example of how to work with cryptocurrency options and how we can potentially send orders afterwards to the exchange. So let's jump into it. In order to work with cryptocurrency options in Python, we're going to start by importing two fundamental libraries, which are ccxt and Crypto-Pandas. Once we have done this, we can initialize a exchange. In our case, we will be selecting Binance. As we can see here, the AI of our IDE has correctly suggested for us that we will be using the default type option and that we also need to load all options symbol. Afterwards, we can create the Pandas exchange wrapper and have a look at all symbols which are trading on Binance options by using this load markets method. And then we're just going to filter out, as you can see here, for symbols with the type option, which are quoted in USDT. So we're not interested in options quoted in USDC or Euro. So before we move any further, why don't we just have a look at what is behind this data? And as you can see here, we get a nice clean data frame containing all of our symbols, as well as some additional information, such as if we can use margins, what is the ID which needs to be used for Binance. We don't see it here, but we also have data with regard to the expiration date and what kind of call, if it is, what kind of options type it is it a call, is it a put? So why don't we just have actually a look at what all that data is. We can see here, it has correctly suggested for us these columns, and now we can reload the data. So yeah, we can see here what is the strike price of the underlying option, when the option is expiring, and whether the option is a call or a put, which is all very useful to determine what kind of options we want to trade on depending on the combinations we want to make. A fundamental piece of data with regard to options is something called the Greeks. So it's different values which are used to understand the volatility of a option and how much risk is associated with buying or selling that option. So we can just use the fetch all Greeks method and then merge that data onto the symbols data frame. I will tell you what, let's actually even filter the symbols here for information which is pertinent to us, and then that way we get a smaller data frame. All right, and now we can see that we have more data related to our options. We get, for instance, the ask implied volatility, the mark implied volatility, as well as the mark price of that option. Now, one thing we want to understand is also whether an option is currently in the money or out of the money. So does that mean that the option is currently going to expire completely worthless, or is it going to expire inside of the money and potentially give us some returns? So to find out whether an option is in the money and how close it is to its underlying price, we need to fetch underlying mark price of that base asset. So we're going to use the ticker price. And so we're going to be taking the index price. The index price is a far better indicator of the underlying value of an asset. So we're going to be using the mark price methods, but filter out for the symbol and index price columns. One thing about this data is that it is about symbols which are trading on spot or futures. So what we're going to do is we're going to query what is the price of the asset on the perpetuals futures, which is going to be our best market for hedging our options. So what we're going to do is just filter out here the index prices for rows where the symbol contains this USDT ending, which means that it is a perpetuals contract. And in order to merge it onto our options, we need to change this column from being the symbol column and turn it into the base, so that it is obvious that this BTC USDT symbol is actually used as the underlying futures of all BTC options. So what we're simply going to do is remove this USDT ending, and on top of that, we're going to rename the column to base so that the merge is going to be a lot simpler. Before we move any further, why don't we just have a quick look at the data. And now we can see our index prices data frame, which contains the base of various symbols. So here, for instance, we see the resolve is currently trading at 0.144 USDT on the perpetuals. We can now take this index price and merge it onto our options symbols data frame. Now let's go ahead and see what our new data frame looks like. So yeah, now we can see correctly that all the BTC options, they have an index price of 108,779, which is the current perpetuals price of BTC. And Solana is currently trading at 203 on perpetuals. So to understand whether a option is in the money or out of the money, we need to look at whether the strike price is above the index price for a call option and whether the strike price is below the index price for a put option. So we're going to create this in the money column. Is the symbol strike price currently larger than the index price, as well as it being a call option at the same time. Inversely, we're going to be looking for puts, whether the strike price is below the index price. I need to correct myself. Call option is in the money when the strike price is below the index price, meaning that it is going to provide a return. And a put option is in the money when the strike price is above the index price, because we can now sell the option at a higher price than what it is currently trading at. So I'm going to fix that here. I'm going to lint my code to make it a bit more readable. So let's have a look at this symbols in the money column now. Okay, so we're getting this error message because we haven't added sufficient parentheses. Let's check this out. All right, perfect. So now we have this column here, ITM in the money, which helps us determine whether an option is in the money or out of the money. And so if we scroll down here, for instance, to some of our ETH options, we see that, for instance, this 4,000 call option expiring on the 26th of September 2025, it is currently in the money because Ethereum is trading at 4,460. So it is currently in the money. On the other hand, its equivalent put is out of the money because we wouldn't be able to sell at a higher price than what the market is currently trading at. So very practical to be able to know whether an option is currently in the money. Also useful is to know how far an option priced compared to its underlying value. And to notice, we are going to calculate the spread between the strike price and the index price. Awesome. So the IDE just proposed this solution, which is indeed what we need. But it's not enough because, for instance, a option which is trading 20 USDT higher on Solana is going to be much further from its index price than an option which is trading 20 USDT higher on BTC, simply because, relatively speaking, 20 USDT is not a lot for BTC, which is trading at 108,000, but it is a lot for Solana, which is trading at 200. So in order to be better able to understand how far an option truly is trading compared to its underlying asset, we need to be able to standardize this strike index spread by the underlying index price. So we're simply going to take the strike index price and divide it by the underlying index price, so that now we get a percentage with regard to how far an option is trading to its underlying index price. And we're going to also add this strike index price absolute spread, which will come in handy later on. So now we've done some extensive feature engineering in order to better understand our options and how they are trading. So in this particular options tutorial, we're going to want to create a calendar spread. Now, for those of you who don't know what a calendar spread is, there is a link in the description below where you can find out more about it. Basically, a calendar spread in options is a combination where you sell one call or put option near in the future, and then you buy another one a little bit further out into the future. future. Now, the reason why you want to do this is because you might be interested in buying an option at a specific date further in the future. For instance, you want to buy an option for after a big announcement, such as cut in the Federal Reserve interest rate or new selection of a presidential candidate, and so on. But since it might be quite expensive to simply buy that single option, you decide to sell another option which will expire before this big announcement. And the reason why you want to sell that option is because it will allow you to make some revenue to offset the price of the option you bought. And also that option that you sold will not be influenced by whatever expected announcement you think will happen at that specific date. So with that in mind, let's go ahead and see how we can create a calendar spread. So we are going to do it on, for instance, BTC. We're going to take our asset to be BTC. We're going to now filter our options for all options where the underlying base is BTC. And in our case, we expect the price to go up following our announcement. So we're going to be interested in call options. There you go. Now that we have this filtered data frame, what we can do is we can filter this data frame for options which are, for instance, out of the money, but just below the underlying strike price. So we're going to now also filter. We can actually add it to this filter here. Let's have a look at our data frame first to make sure that everything is correct. All right, so as we can see, we now have indeed a filtered data frame containing call options only on BTC. And if we look at the strike price here, strike index spread, we see that they are all positive, which means that they are not in the money. We want options which are not in the money, so the strike price is higher than whatever Bitcoin is currently trading at. Now, let's say we expect the Federal Reserve cut to make a big difference, which is going to happen actually somewhere around mid to end of September. So we're going to create a cutoff date for when we expect this announcement to happen. And as you can see here, it has suggested for me 17th of September 2025. So now we can filter, for instance, for our sell leg, which is going to be an option which is expiring before the cutoff date. And we're going to be looking for our buy option, which will expire right after this cutoff date. One thing we want to look into in particular is to find the option which is currently just above the current index price, because it is the price which is most likely to turn into the money should the announcement lead to a bullish market. So if we're trading currently at 108,000 and we expect the announcement to lead to some bullishness, the call option around 110, 115,000 is very likely going to end up in the money. So we're now going to sort the symbols data frame before we do the filtering by both strike index spread relative that we have created earlier. So we're going to be able to find the one which is closest to the underlying index price. And then we're also just going to add this expiry date time sorting. And we're going to specify that we want the options with which was the lowest spread at the top. So if we want the lowest spread, we need to filter both columns by ascending. So now that we have done this, let's have a look at our new sorted data frame. And since we have already done the cutting for finding out our sell and buy leg, we can simply have a look at those data frames too. So if we scroll up here to our sorted data frame, we see now that the 109 calls are being placed at the top, which is indeed what we would like, since they are the most likely to expire in the money should any bullishness appear. And if we look down here, we get our sell legs, which are going to expire either on the 1st of September or on the 2nd of September. And down here, we get our buy legs, which are expiring on starting on the 19th of September. So that is the first option existing after this cutoff date. Now, what we need to do is we want to filter out for just one option. And so for the buy leg, it's quite simple. What we want is this top row here, which is going to be the 109 call option expiring 2 days after this announcement date. And for the sell leg, what we actually need is the call option, which is expiring just before this cutoff date. So we actually need to change our sorting such that we get the last expiry date time at the top of the data frame. As we can see here, it's probably going to be this 12th of September 2025 call option. So let's change this sorting. We're still going to leave the strike index price, but for the sell leg, we are going to sort the expiry date time from the last to the earliest one. And for the buy leg, we're going to sort both columns in ascending order. And so now that we have done this correctly, what we can do is we can simply filter out for the first row of each of these data frames. Even better would be to simply afterwards convert this to a dictionary so that we have a easy to use format. So let's actually, rather than using head of one, we convert to dictionary. Let's clean up this code first. Now let's go ahead and have a look at our output. Very nice. So now we can see that we have our sell leg, which is going to be the 109,000 call option expiring on the 12th of September 2025. And our sell option is going to be the 19th of September 2025 call option. And if we look at the underlying data of both of these options, we can see that they have actually quite similar delta values. And if we look at the mark price, which is the ideal price for that option at this point in time, we can see that September 12th option, its ideal price is 2,892.6, whereas the September 19th, its mark price is 3,761.7. So that's nearly a 1,000 euro premium for a 5-day difference in option expiry. But of course, the market has priced in the possibility that we will be seeing a cut in the federal interest rate. It is not surprising to see this difference. Nonetheless, let's proceed with how we can send orders on these options in order to create a calendar spread inside of our positions on the exchange. And so to do this, it's quite simple actually. We're just going to use the CTXT methods of create order. So now we're going to create first the buy leg. So the buy leg is going to have side buy. We're going to place it on this symbol, which is provided inside of the dictionary. We're going to be placing a limit order because market orders are not possible in options since the bid-ask spread is quite large and can lead to substantial losses. And then we're going to place a order for one call option. And one thing which is important to look into when it comes to placing orders on futures and options is to look at the contract size. So actually the contract size is data that can be found inside of the load all markets method. And let's just add that data to our symbols data frame. Let's comment this out for the time being. All right, so now if we look at the dictionaries of our buy and sell legs again, we can find the contract size is 1 for both options. So it means that if we buy one contract of the option, we are buying the right to buy the right for one asset of the underlying Bitcoin. So there is no need to modify our amount for the contract size since it is not like we are buying 100 Bitcoin for each contract we buy of the option. And then the price we are going to be sending the order at is going to be the mark price, but we will need to provide some premium. So we can add a config where we specify, for instance, we want to add 5% in order to guarantee that our buy order is executed. But this can of course be added to a config.py file or can be made dynamic based on whatever logic you have created. As for the sell leg, it is pretty much the same thing, except we're changing the type to sell and we're changing it to a different dictionary. And we need to specify a price which is lower than the current mark price in order to be executed. Now, I'm not going to run these two examples here because it might lead to trades happening, which I do not want at this point. And Binance does not provide a test environment for its options trading. So be careful when you start trading options programmatically through Python. Make sure that you have tested your code properly and that everything is working well. But if you manage to get everything working well inside of your code, and you're confident with the proper management of the risk, this is actually a very cool way of profitably trading out options and making revenue. Now, this was a longer video than usual and required some investment from our side. So if you guys found this video useful and interesting and you want to see more cool algorithmic trading videos such as this, your support means a lot to the channel. So please leave a like or a comment down below to let us know that this is providing value to you. We hope you guys like this video, and we will see you in a future one.